Hello, everyone. My name is Dr. Joshua Aura. I work for two companies. I work for Aura and Company, which is a licensed firm by ISPAC that offers tax, internal audit, external audit, and advisory services. I also work for RCM College. And today, I would want us to discuss some very important audit concepts, what we call going concern. Going concern. Whenever your auditors visit you in your workplaces, you must be hearing them talking about, is your company a going concern or not? And they have to do that because as external auditors, we have a role over what we call going concern. In auditing, the going concern assumption, going concern, going concern, going means what you're continuing. All right, refers to the expectation that a company will continue its operations for the foreseeable future without the intention or need to liquidate its assets or cease operations. So, of course, this is a firm that is not, selling its assets. You're selling your assets. That means what you're making your assets to become liquid. Once you start realizing that you are selling your, property, plant, and equipment, you're liquidating your PPE, then automatically that means that you want to stop business. All right. This assumption is fundamental in financial reporting as it underpins the preparation of financial statements based on the belief that the company will remain viable. The company will remain viable for at least 12 months following the end of the reporting period. As part of their responsibilities, as part of our responsibilities, as part of our Aura and Company, such as financial difficulties, legal issues, or operational challenges, they must take specific actions. And these actions, of course, include evaluation of the management's assessment. Because remember, it is your primary role as managers of your company to assess your company, whether it is a going concern or not. So then the auditor, myself, is to come and review, all right, your assessment. The auditor reviews management's own evaluation of the company's ability to continue as a going concern and assesses whether it is reasonable. Number two, we always work on evidence. Obtain sufficient, appropriate audit evidence. The auditor must gather appropriate evidence to form an opinion on the going concern assumption. This may include examining financial performance, reviewing management plans, and considering external factors like economic conditions. The other action will be to report our findings on this going concern issue. If a material uncertainty exists and is adequately disclosed in the financial statements, the auditor is required to highlight this uncertainty in a separate section of the audit report titled Material Uncertainty Related to Going Concern. All right. So if we have these going concern issues that have been disclosed by the directors of the company, they have disclosed by the directors of the company, then we as auditors, we must also report these in the auditor's report. And we're going to introduce a new section known as Material Uncertainty Related to Going Concern, MURGC, Material Uncertainty Related to what year? To Going Concern. The auditor's opinion on the financial statements will remain unmodified. So long as the directors have been able to disclose that they have got an issue to do with going concern, mine is to emphasize. Of course, I'll not put this under emphasis on matter, but I will be able to introduce a new section known as what year it will be titled. That section will be titled Material Uncertainty Related to Going Concern. The auditor's opinion on the financial statements will remain unmodified unless the uncertainty is not properly disclosed. Audit evidence. Audit evidence refers to the information used by the auditor to reach conclusions that forms the basis of the audit opinion. It includes the information in the accounting records underlying the financial statements, as well as information from other sources. Remember, evidence could either be internal or external. This evidence is crucial for the auditor to assess the going concern assumption and to determine whether there are material uncertainties. Example of disclosure. I like always being very, very practical by giving you examples for you to know how this will be captured. Under this section known as material uncertainty related to going concern. So example of disclosure. We draw attention to note number 6 in the financial statements, which states that the company incurred a net loss of ZZZ for the year ended 31st, 2021. As of that date, the company's current liabilities exceeded its total assets by YYY. So you can see this basically is an illiquid company. Whenever your liabilities exceed your assets, it means that you are illiquid. You will not be able to progress, continue as a business. As noted in Note 6, these events and conditions, along with others discussed therein, indicate material uncertainty that may cast significant doubt on the company's ability to continue as a going concern. Our opinion is not modified in respect of this matter. Key considerations. Generally, if either the directors or auditors believe the company may not survive the foreseeable future, a going concern issue arises. While the term foreseeable future is not strictly defined under IFRS, it is typically considered to be no less than 12 months from the end of the accounting period. It is ultimately, I repeat this, it is ultimately management's responsibility to assess the company's ability to continue as a going concern. My role as an auditor is to obtain sufficient, appropriate evidence, form conclusions based on this evidence, and report the findings appropriately. My name is Dr. Joshua Aura, and I love audits. Please subscribe and ensure that you are sharing these videos that I do on auditing with your bosses. It's very important for your bosses to also get some understanding of the work of audit, for them to appreciate what auditors do, so that we can be able to assist your company to be a going concern. Thank you so much, and bye.